If you've ever wondered why some people seem to build wealth effortlessly while others struggle for decades, the answer often comes down to one simple principle: compound growth. It's not about luck. It's not about timing. It's about time itself. The people who understand how compounding works and start using it early end up achieving the kind of financial independence that most only dream about. And here's the best part: anyone can use it. Let's start with a simple question: would you rather have $1 million today, or a single penny that doubles in value every day for 30 days? Most people instinctively take the million. But if you chose the penny, you'd end up with over $5 million by day 30. That's the power of compounding: the small, consistent growth that snowballs into something extraordinary. Compound growth works on a simple principle: your money earns returns, and those returns themselves start earning returns. It's growth on growth. Each cycle accelerates the next, creating exponential wealth over time. The earlier you start, the more powerful it becomes, because compounding needs one ingredient above all others: time. Here's how it plays out in the real world. Imagine you invest $1,000 at a 10% annual return. This is why the wealthy always say, "Don't work for money, make money work for you." When your money compounds, you're no longer trading time for income. You're building an engine that grows while you sleep. Now, here's where most people go wrong: they underestimate the value of consistency. They think small investments aren't worth it. But compounding doesn't care about the amount, it cares about discipline. Let's say you invest $200 every month in an index fund averaging 8% returns. After 10 years, you'll have around $36,000. After 20 years, $118,000. After 30 years, $282,000. And after 40 years, over $700,000. That's not theory, that's math. It's not about chasing big wins. It's about consistent growth. Even Warren Buffett built most of his fortune after the age of 50, not because his strategies changed, but because compounding had enough time to accelerate. Buffett himself once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." So why does time beat timing? Because the market rewards patience. Many investors waste years trying to predict highs and lows, but even missing a few of the best performing days can destroy long-term returns. Studies show that if you miss just the 10 best days in the S&P 500 over 20 years, your total return can drop by almost half. That's why the most successful investors focus on time in the market, not timing the market. But let's be honest, staying invested through market downturns isn't easy. Fear, uncertainty, and headlines can make anyone panic. That's where emotional discipline comes in. Compounding only works if you stay consistent, even when it feels uncomfortable. Every crash in history has eventually been followed by recovery and growth. Those who held on, reinvested dividends, and stayed patient always came out stronger. Another key aspect of compounding is reinvestment. Many investors take their dividends or interest and spend them, but the real growth happens when you reinvest those earnings. Each reinvested dollar becomes a new generator of returns. It's like planting a tree and using its seeds to grow a forest. Over time, that forest of investments becomes self-sustaining. Here's a pro tip: automation is your best friend. Set up automatic contributions to your investment accounts. When investing becomes a habit rather than a decision, compounding becomes unstoppable. You eliminate the temptation to skip months or time the market. Let's talk about the mindset that fuels compounding. Compounding isn't just a financial concept, it's a psychological one. It rewards patience, consistency, and delayed gratification. It punishes impulsiveness and short-term thinking. The same principle applies to skills, relationships, and personal growth. Every small improvement compounds into something meaningful over time. Financial success is no different. One of the biggest mistakes people make is interrupting the compounding process. They withdraw investments early, cash out during fear, or constantly switch strategies. Every reset costs time, and time is the one variable you can't replace. Think of compounding as a train slowly picking up speed. If you stop it every few miles, it never reaches full momentum. But if you let it run uninterrupted, its momentum becomes unstoppable. Here's something most schools never teach: the difference between simple and compound interest. Simple interest grows linearly, you earn on your original amount. Compound interest grows exponentially, you earn on your earnings. Over decades, the gap between the two becomes enormous. Let's apply this to real life. Suppose you're in your 20s and start investing $300 a month at 8% returns. By age 60, you'll have over $1 million. If you wait until your 30s to start, you'll end up with around $450,000. Waiting just 10 years costs you more than $500,000, all because you lost compounding time. Time, not talent, is the greatest wealth multiplier. Now, what about inflation? Doesn't it eat away at returns? Yes, but that's exactly why investing is necessary. Keeping money in cash guarantees loss through inflation, while investing at even modest returns allows you to outpace it. Compounding is the only proven defense against the slow erosion of purchasing power. Compounding doesn't demand perfection, it demands consistency. You don't need the highest returns, you need steady returns that keep working for decades. Think of your portfolio as a farm. You plant seeds, you water them, and you let nature, or in this case, time, do the work. You don't dig up your crops every month to check their roots. You stay patient, because you understand growth takes time. As your portfolio compounds, there's a psychological shift that occurs. You realize that wealth isn't built by one-time decisions but by long-term systems. The earlier you build those systems of automated contributions, diversified investments, reinvested earnings, the faster your compounding engine grows. Before we conclude, let's summarize the core principles of compounding that can transform your finances. Start early. Time is your greatest asset. Stay consistent as small amounts add up. Reinvest all returns. Let your money multiply itself. Avoid emotional decisions. Stay invested through ups and downs. Let time do the heavy lifting. Patience builds wealth. Compounding is the bridge between effort and freedom. It rewards those who play the long game and punishes those who chase quick wins. The market doesn't care about your emotions, your predictions, or your opinions. It rewards patience, discipline, and time. And remember, this video is for educational purposes only. Always do your own research or consult a licensed financial advisor before making investment decisions. If you want your money to grow, stop focusing on how much you can earn today and start focusing on how long you can let your investments compound. Because wealth isn't built in months, it's built in decades. If this video helped you understand the real power of compounding, make sure to like, subscribe, and share it with someone who needs to hear this message. Because when it comes to building wealth, time really does beat timing every single time.